Market swings have become the norm, with volatility rising sharply over the last few months, and some investors have been caught off guard after being lulled into pretty decent returns over the last few years. So what does the volatility mean for investors, and what's ahead? Bruce Cooper, Chief Investment Officer, TD Asset Management, joins me to discuss his latest Forward Perspectives paper. Well, welcome, Bruce.
Great to be here.
So why are we seeing all this increased volatility in the markets?
Probably our most important theme this year that we've been talking to our clients about is that we do anticipate an environment of more modest returns with higher volatility. So this doesn't come as a surprise to us. It's something we've really been talking about since the very beginning of this year. But I think there's been a couple of triggers, and geographically, China and Europe have been front and center, I think, in investor concerns this year.
So what's going on in China?
So on China, I think the big story is that growth is slowing. And as we know, for many years, China grew at an exceptionally rapid rate, above 10% for something like 30 years. It's just an amazing accomplishment. But today, growth has retreated. Officially, growth is 7%. But we think probably growth is a little bit lower than that. And persistently going forward, we had to anticipate kind of low to mid-single digit growth rates in China, which is a big, big change compared to where we saw before. And given the importance of China to the global economy, that kind of downshifting in growth is having significant impacts across the world.
And Europe, and I know especially Greece, has been in the news as of late the last few months.
Yep. Yeah, Greece has been in the news. Today, as we sit here today, it's kind of out of the news again.
Exactly.
And in some senses, people are relieved about that. But we're cautioning people that doesn't mean all the problems in Europe are over. There's what we call unresolved imbalances in Europe. It's kind of a fancy phrase, but what it really means is you've got all these countries in one currency zone, which is the euro, and that is creating challenges because traditionally currency was, think of it as like a relief mechanism. If your country wasn't quite as efficient as other countries, you could devalue your currency. Today, for those countries in the Eurozone, they can't devalue their currency. They're stuck there. And so for a lot of the countries on the periphery, which would of course include Greece, but also Italy is having some economic challenges, Portugal, Spain, they're in the same currency zone as Germany, and that means that traditional relief valve of a lower currency is not there. That means they have to get more efficient, they have to restructure, not always easy politically.
So what does this mean for investors then if we take it all together? Are equity returns going to get worse?
Well, this has been a challenging year, and so I wouldn't say they're necessarily getting worse from here. Our kind of core long-term view is we expect mid-single-digit returns from equities. So it's not a disaster. In fact, inflation is running at 1 or 2%, so we still expect equities will give you returns above the rate of inflation, which will allow you to grow the real value of your savings over time. But it could be a volatile path to get there. And so people need to kind of fasten their seatbelts and be prepared for some volatility if they own equities. And we've gone more cautious earlier this year. We went more cautious, but we're not negative. So we've kind of gone from being optimistic to being more neutral. But we would definitely distinguish that from being negative. We're not saying that the sky is falling.
So any particular number you can give me in terms of where you're seeing equity returns going? Yeah,
as I say, I think mid-single digit would be a kind of broad expectation over a longer period of time. Obviously, in any day, month, or quarter, you can be much different than that. But if we looked out over the next 2, 3, 4 years, we think that sort of mid-single digit level from equities and a lower single digit from fixed income would be a reasonable expectation for our clients.
And you mentioned in your Forward Perspectives article that the high historical interest rates of the 1980s are probably an abnormality. So what are you saying for interest rates ahead?
Yeah, we've definitely been in the lower for longer camp, and it's really linked to our view that we think growth is going to stay low. So global growth is low. That translates to a persistent period of low rates. In the piece we put in place a chart that goes back to the 1700s, which is a long period of time. And what it really shows is the period post the Second World War, really in the 80s and 90s, I should say, was an anomaly. You had very high interest rates then. Over much longer periods of time, interest rates in this kind of 3–4% range is much more normal. Given that lower level of growth we think it could be back in that kind of lower for longer camp. That's okay. There's still a role for fixed income. It provides stability to a portfolio. It does provide a modest level of income, which is great. But the old role that it played for many years of giving you capital gains and yields in the sort of mid to high single digits, we do think that is behind us.
All right. Well, thank you very much, Bruce.
Great to be here.
I've been joined by Bruce Cooper, Chief Investment Officer, TD Asset Management. I'm Marianne Devenney. Thanks for watching.